is now the time to buy Adobe stock, especially now that it's down over 50% this past year, gotten hammered. And I'm free falling the last couple of days following their weak earnings announcement as well as their acquisition to Figma. We'll talk about the acquisition of Figma. We'll talk about in a second. First, it's important to call out, I previously did a video on Adobe back when it was around 570. It had just fallen below $600 a share. And I was telling folks, look, valuation matters. I said the risk reward wasn't that compelling. I just showed you a screenshot literally of the video saying, yeah, it's just not that compelling. I'm looking for more asymmetric bets than what you saw with Adobe. The key of this channel, what I'm focusing on is unrivaled companies, businesses that have the right to win long-term, looking for growth, and I want that valuation. I want a compelling deal. I want asymmetric upside, and you didn't have it then. Maybe you have it now with a much lower price. We're going to talk about that in a second. So to understand Adobe, quick, first a step backwards, what are they even doing? They're still this software juggernaut that I talked about in the last video. They're still empowering a massive global digital transformation. They have three core business lines: Adobe Creative Cloud for, designers and creators, Adobe Document Cloud for editing and managing documents and PDFs, and Adobe Experience for marketing, automation, and analytics. Super high level overview of Adobe. You can see that they've grown their subscription-driven business significantly over the last few years, a 24% subscription revenue CAGR, and around a $16 billion revenue from last year. And you can also see that they've had very fat profit margins, around GAAP profit margins, which is what I want to see, around 35%, give or take. And then fast forward to the most recent quarter, and you see their sales growth has decelerated a bit. You're no longer talking about 20% plus growth rate. Now you're talking about 13% sales, and you're looking at profits only grow 3%. So investors are kind of bummed out. Well, what is management even investing in? Because their revenue grew by 400 million, their profitability grew by 400 million, their gross profit. So the core business is still very lucrative. Well, what are they investing in? Well, they invested in 200 million more in sales and marketing, and they still weren't able to get sort of the growth that you want, the growth sort of acceleration or continued, let's say high, close to high teens, maybe 20% growth rate. They're still not there. This business has decelerated, partly due to a strong US dollar, partly due to a weaker economy. But looking at this might get management a little nervous. Wait a second, we're pressing our foot on the gas pedal. Something's not working. We're not getting the growth we want. Oh, you know what? Let's do an acquisition with someone that is growing. So they also announced this acquisition of Figma. And there's a lot to like about Figma, talking about, hey, they're tackling this big market, 16.5 billion across design, whiteboarding, collaboration. They're expected to add 200 million of annualized recurring revenue in 2022 to surpass 400 million of ARR this next fiscal year, and retention of greater than 150 million, net dollar retention of greater than 150%. So this business, just from its prior customer base, was growing at least 50%. And so what you're looking at, here it is, a business with gross margins of 90%, positive operating cash flows. This is a business that's self-financing. And they also talk about how Adobe and Figma are used by a large and growing number of joint customers. I look at this and I think there's a lot of code here that management is saying. They're saying, hey, this joint customers bit, that's actually saying we could have won these customers over, but instead they went to Figma. And so these are joint customers. But in reality, this is a competitive threat. And oh, by the way, this company is positive operating cash flow. So this company is self-financing and they're growing ridiculously fast. So, ruh-roh, this might be a problem for us because this business, has attractive margins like we do, is self-financing with positive operating cash flows. Yeah, we recognize it's only 200 million of, annualized recurring revenue. Maybe this business is generating a couple hundred million in revenue at most, around now, because they're saying to surpass 400 million ARR exiting fiscal year 2022. So, all in maybe 200, 300 million in revenue that you maybe considering. And so they might be concerned about this. And you even look at Figma's website and they're like, oh yeah, you should choose us over various different Adobe products. And you look at what's being written online, folks are saying, yeah, Figma versus Adobe Photoshop. Talking about, look, there are two different applications. Photoshop is a large application, which is heavy on, effectively computer usage and must be installed on the computer, whereas Figma, it's, much easier to run. It's better than Photoshop as it's much more responsive despite using fewer resources. So that's one person's take. Other people would say, hey, you can't compare Photoshop to Figma. There are other folks saying, look, 8 reasons why every product design team needs to use Figma or get left behind. Talking about how the reason why Figma is winning so fast is because it enables sort of this frictionless ability to share files with different users, the ability to work in real time with colleagues. And there's talking about cost savings. I mean, this has certainly been a lever that Adobe has pressed of sort of raising prices over time. A lot of folks with the Adobe suite are used to paying $50 a month. Here it is, you might have Figma coming in much lower than that. People are saying, hey, why don't we sort of stick it to Adobe and, try out a different product that makes it a little bit easier for collaboration. Now, keep in mind, it's not, apples to apples comparison. It's just competing in some aspects of this niche. It's a niche competitor. It's not a complete competitor with Adobe. And so here it is, 200 million ARR, maybe 400 million ARR by the end of this year. They're paying $20 billion. That is a lot, 100 times annualized recurring revenue. They're paying half cash, half stock. Very, very expensive. You could, another person might say, well, maybe it's really like 50 times because of their, they're going to be at 400 million. And, I just look at this and I'm thinking, wow, management is paying a lot. In addition, they're doing another 6 million in restricted stock units to the CEO and employees. So another couple $2 billion just for, sort of keeping them around for another 4 years. This just reeks of desperation and fear, because if you have a business model where you're like, hey, we are going to crush it. We know we're profitable. We know we're unrivaled. You don't have to make these types of moves. That at least what it strikes me like, hey, this is a business that was generating a couple $100 million in revenue. You have Adobe that generates closer to 20 billion in revenue. They have the gross profitability that they could have easily invested to create a product like this. This means they are fearful of their business model, or they're looking to sort of acquire or smother a competitor while it's still in the cradle before it represents an existential threat to Adobe. That's sort of what it seems like to me. I mean, a lot of different angles. Now, some people might say, well, wait a second, Daniel, like this could be like Facebook buying Instagram for like $1 billion before, Instagram was anything. And now Instagram's, a huge chunk of Facebook's business model. But reality is Facebook paid effectively 1 year's worth of free cash flow, and they were going very quickly. And the reality is within a year, it would be less than that when you think about free cash flow, excluding their growth investments. Whereas here, Adobe's paying 3 to 4 times their free cash flow for this. So this is a sizable bet. They're saying, we're effectively taking this cash flows and putting it into a business that's effectively a rounding error for them on a financial perspective. Talking about 200 million in revenue, 400 million in revenue. Like, you need to deliver continued amazing growth to even prove not to be a rounding error for Adobe in sort of the years ahead, thinking about it. So the question is, okay, so is this priced into Adobe now? Where does Adobe go from here? If you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. And full disclosure, this is not financial advice. First, my concerns about management not really knowing how to allocate capital, overpaying for Figma. Maybe it's a smart strategic, position. Then I'd say, okay, well, what has management done to prove their capital allocation skills? Have they, for example, done intelligent stock buyback? So let's try to judge management. In all honesty, this is one of these things that sort of shocks me, how incompetent many management teams are when it comes to just the basics of capital allocation, which is like buy when it's a compelling investment, when you can pencil out an incredible return on investment. My prior video was like, no, this is not compelling. You should not be buying back stock. And you look at what they've done the last few years and effectively buying, yes, $4 billion worth of stock last year, offsetting about $1 billion of stock-based compensation, $3 billion the year before, $3 billion the year before that. So the biggest was last year. And at that point, they were buying at an average price of $536, a price that I didn't think was compelling at all. So once again, now you sort of have 2 data points sort of saying, okay, management may not understand what capital allocation is. Maybe they should go watch some videos of Warren Buffett talk about what the CEO's job is, because ultimately it's intelligent allocation of capital. What are you doing with the profits of the business? Where are you putting it? So that way the business grows free cash flow per share over time. Paying too high of a price hurts your free cash flow per share over time. Looking at Adobe stock price, thinking about the current valuation framework. Keep in mind, this is a hypothetical framework. Now that the stock price is around $300 a share, I'm looking at this thinking, you know what? The return potential is certainly more compelling than when I last called it out. I'm effectively saying, look, maybe they do mid 30s, high 30s profit margins. Maybe they grow around 12% this year. Maybe they grow around a teens rate in the years ahead. And they're going to generate significant free cash flow that they can return to shareholders. So I look at this and I think, this could outperform the S&P 500. I do think it is more reasonable. What bothers me at this point is sort of seeing management's past decisions and sort of saying, well, could they just do something stupid in the future? Because arguably they're overpaying for Figma, or they should have moved faster, or they should have invested in the business, said, hey, we're not going to have 35% margins this year. We're going to have 10% margins this year because we're making this huge investment to create similar products or better products that are more collaborative. So that way you sort of crush the competition versus having to pay, such a significant price. And so I look at this and sort of say, the valuation is all right. It wouldn't surprise me if it outperforms the S&P 500 from here, given, it generates significant free cash flow, given that its growth rate is, above average for, let's say, the S&P. It's a quality business. Don't get me wrong. It's still $100 billion plus business. I'm just not crazy about it. I'm still not thinking, hey, this valuation is deeply compelling. I'm saying 5 years from now, effectively 20 to 25 times earnings. So I'm looking at this, it's pretty good. It's not amazing. I personally want to find more asymmetric bets where I'm sort of saying, hey, does this company have, let's say, 300% upside or 600% upside over time, and where can I get it wrong? And is management sort of in my corner? Are they doing the right things? Does management have, let's say, stock options that only get paid if the stock is like 300% more upside from here? So I'm looking for those types of situations. This one still strikes me as like, meh, I think I could probably get a better price on Adobe in the future. That's my personal approach. Looking at this, it's an interesting setup. It's not compelling in my opinion at this point. Could I see the stock price much higher, let's say 5-10 years from now? Quite possibly. A lot's going to depend on the execution of the business. Could they do better than, let's say, their recent growth rate? Could they do, let's say, 14% annualized growth in the years ahead? Will it still have, let's say, a 25 times earnings multiple? And will they be able to prove out higher profitability around 39%? Or will management continue to make, sort of these smaller acquisitions using, paying full prices and using, debt to do so, using, a combination of cash, stock, it's not clear to me. And I look at this and I think it's reasonable, but not deeply compelling. Anywho, if you enjoyed this video talking about Adobe stock, ADBE, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.